Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Karen Vera, head of iShares US fixed income strategy at BlackRock. BlackRock, as we know, is the world's largest asset manager. They offer over 424 ETFs in the US markets, including 131 fixed income ETFs, both active and index tracking across a variety of strategies. So we're talking about bond markets and some interesting fixed income ETFs today. Karen, welcome. Great to have you on the show.
Thank you for having me today.
So all eyes today were on Jay Powell, the Fed chair, who spoke at the Economic Club of New York just before we started recording. And for reference, we are recording on October 19th. And Chair Powell reiterated the Fed's commitment to bringing inflation down to 2%. So let's start with the Fed, because the main concern for investors currently is whether stubborn inflation will force the Fed to keep interest rates higher for longer. And in fact, the minutes of the most recent FOMC meetings revealed that a majority of committee members say that one more rate hike would be appropriate. And but lately, the bond market has been doing some work for the Fed. So tell us what is next for the Fed's rate hike in your view?
That's a great way to put it, Nina. We've definitely seen every other week we see whether it's new economic data or some of the members of the FOMC speaking in public. The market has started repricing in some of the rate hikes. So where we sit today, we've got two more Fed meetings left this year. We've got a November 1st and a December 13th meeting. Right now, the market is pricing in a lower probability of the Fed hiking after today's comments. So we're still at 525 to 550. They've done a pause basically since July because they're trying to see, they want to see inflation come down without it causing a slowdown in economic growth. And I think they're still seeing inflation being stubbornly high. So we could see the Fed continue out with this pause and maybe do one more hike, because as you just mentioned, many of the committee members are leaning that way. And then to your point about the bond market doing their work for them, we've seen the 10-year yield over the summer go from about 3.75 to just under 5%. So that's another 125 basis points of long-term rate increases, which that really impacts borrowing costs. It impacts mortgage rates. So we're seeing the Fed's really digesting a lot of that news. But I think everybody's reading into every little statement that they make, but we're still at a point where we're seeing some pausing on the horizon with at least the November 1st meeting, some probability that they could raise rates during that meeting.
So let's talk a little bit more about the sudden spike in yields. So because this massive sell-off in Treasury bonds has been one of the biggest story in markets lately. And experts say that several factors could be responsible for this sudden spike. It could have been caused by a significant selling from a US or foreign institutional investor or a foreign central bank, and of course, rising fiscal spending and a ballooning deficit, and that coupled with political dysfunction in Washington. They are also impacting the cost of borrowing. Interest rates have been inching higher since the Fed started raising rates about 1.5 years ago. And the bond issuance by the Treasury has been increasing to finance a surge in budget deficits. And there are not a lot of buyers now in the market. So that is creating this mismatch between demand and supply. But even then, the speed of the latest sell-off surprised many experts. So what caused the recent bond sell-off, and do you think it is over now?
Yeah, we saw interest rates coming up pretty dramatically this summer, and once again it corresponded with some of the concerns about Congress and Washington and the ability to raise the debt ceiling going forward. And then the U.S. government got downgraded by Fitch. We'd been downgraded by S&P many years ago. So now we have two rating agencies that have the U.S. below that AAA rating. And so I think that really did cause some international investors to lighten up their exposures to treasuries and demand the interest rates on bonds are driven by supply and demand. So if the government is issuing more debt to cope with some budget deficits, and there's fewer buyers out there who are willing to buy the bonds, then thus we see the interest rates go up as a result of that, because investors are demanding more and more yield. We've also seen the term premium just coming back into the market. If you think about long-term interest rates, what really drives those? It's a combination of inflation plus economic growth. So if we're going to be in a higher for inflation for longer regime, and we're still seeing positive economic growth, then that means that longer term rates should be higher. So I think as investors were rethinking and getting more economic data and more inflation data, they were bringing that term premium back to the market. We've also seen just less central bank buying, whether it's by the Bank of Japan, whether it's by the ECB, the Bank of England, and in Canada. All of those banks are on slightly different versions of their tightening cycles, but we're just generally seeing less accommodative policy there. So in terms of buying the long-term bonds. So when you bring all those factors together, that's why we saw this big run up in yields in the long end. So I guess the second part of your question, is it over? That's really the question the market's trying to answer. I think we're in for more volatility in the bond market until we get clarification about what the Fed's going to do. We've been in this good news is bad news scenario because we get good news about the jobs and the state of the economy, and then the market actually doesn't respond positively. You'll see stocks go down. You'll see bond yields continue to go up because they think the Fed might continue to tighten those short-term rates even further. So that's really the regime we're in. More volatility, especially in the long end of the curve. Yields are higher, so anybody looking to get into fixed income right now, they can get more and more yield on their bond portfolios. So we've been working with a lot of investors who are looking at different parts of the yield curve and trying to decide how much duration to add to portfolios.
Thanks for talking about the term premium and explaining. I was listening to Chair Powell's Q&A, and he also talked about term premium. So let's talk about the impact on the broader economy, because the U.S. economy has remained remarkably resilient so far, despite sticky inflation and surging yields. But now some experts worry that the sudden spike in long-term interest rates could be threatening hopes for an economic soft landing. So could you tell us what are the implications of the recent bond sell-off for the broader economy in your view?
I think for the broader economy, the most recent bond sell-off means that it's going to be more expensive to borrow, whether it's a corporation or an individual. And so I think, whenever we see a tightening cycle like this, over time, it tends to expose any companies that have some weaknesses. And so we're looking a lot at companies that have high levels of leverage and may not be able to roll that paper. Maybe their business model made sense when they could get funding at 5%, but now that they're looking at 8, 9, 10%, it could be more problematic. So I think higher financing costs over time could contribute to a slowdown, or at least some winners and losers in certain industries. And I think the other big thing that we're looking at as well is the mortgage market. We saw headlines this week that new mortgage origination rates are now hitting 8%. And I think that cost of the monthly payment on a mortgage is going to greatly increase. And so we're seeing a slowdown in housing starts, meaning builders aren't going to be building as many homes, and very low levels of inventory. A lot of homeowners refinanced their mortgages in 2020, 2021, when they were able to capitalize on those lower interest rates. And they're going to remain in those homes for quite some time because they do have such low mortgages. So I think that is going to cause some stress on the housing market because there'll just be less turnover of homes. So that's another thing I think that could threaten the soft landing hopes, just how this plays out, the dynamics in the mortgage market.
Right. So as yields continue to march higher, losses on longer duration bonds continue to pile up. And the iShares 20-plus year Treasury bond ETF, ticker symbol is TLTW, T, that has plunged to its lowest level since 2007. It is down almost 15% year to date and more than 50% from its all-time closing high in 2020. But investors love this ETF. It seems they have continued to pour money into longer duration bond ETFs. And particularly this ETF has gathered almost $18 billion year to date. So tell us what is going on? Why investors are pouring so much money, billions, into these longer duration bond ETFs?
Yes, Dina, this does seem surprising. If you told investors that there was a stock that was going to be down by this much, yet investors were still going to be investing in it, you'd think that they've lost their minds. But when we just take a step back and think about the role of interest rate risk in portfolios, interest rate risk or duration tends to be a factor that is negatively correlated to the stock market over time. So what I think a lot of investors are doing is they're looking at their equity portfolios. They're concerned about a potential recession and what that might do to the stock market. And one of the ways they can add some portfolio protection is through interest rate risk. And since TLT does hold those longer duration bonds, it does have an average duration right around 18 years. So meaning if interest rates fall by 1%, you could get an 18% positive price return on TLT. So what's been happening is the opposite of that. With interest rates continuing to go up, it's caused those bond prices to go down. So I think people are buying TLT both for the income, for some portfolio insurance. And generally, we noticed a lot of investors coming into this year were generally underweight fixed income. And so they're using TLT as a way to add some of that diversifying interest rate risk back in portfolios.
And on the other end of the spectrum are ultra-short bond ETFs, which are also very popular with investors. So these cash-like funds, they also have been gathering billions. And in fact, we know that money market funds have gathered over $1 trillion over the past year. Your ultra-short bond ETFs like the iShares 0 to 3 month Treasury bond ETF, ticker symbol is SGOV, that has also taken in over $10 billion this year. So do you expect the popularity of these cash-like instruments and ETFs to continue? We know that the cash looks very attractive now. And in fact, Bloomberg pointed out that for the first time in this century, cash pays a higher yield in interest than the S&P 500 earnings yield. So do you expect the popularity of shorter duration bond ETFs to continue?
I do. I think we're going to continue to see investors thinking through the cash equivalents and other ultra short bond products they have and really getting that liquidity mix right. So if I think about money market funds, that $1 trillion that we've seen go into them has primarily been into government money market funds because you can get almost a 5% yield without taking on hardly any risk. And so I think that's where a lot of people have moved money into cash because they're worried about interest rates going up. They're worried about a recession and stock prices going down, and then they can just simply hold the cash. We also see people really tiering out that liquidity. And I think that's where funds like SGOV, our 0 to 3 month Treasury ETF comes in handy. Is you can have some of the money that you need to have over very short time horizons, call it 3 months or less. Maybe you have that in a money market fund. Then for money that you don't immediately need, you can put it in a short-term bond ETF. And you can even take on a little bit extra credit risk. We've also got an ETF, iShares ultra short bond ETF. The ticker's ICSH. And that one holds more credit risky securities like commercial paper and ultra short term bonds. And so you can even take on a little bit more credit risk and get some more yield. So I think as investors are looking at their cash, we had with the downturn in some regional banks back in March, we saw a lot of people moving money out of deposit products and into money market funds and into short-term ETFs. So I think especially as we continue through this tightening cycle, people looking for yield, people looking to preserve the value of their cash, I think ultra-short bond ETFs are going to have a place in portfolios alongside money market funds and alongside other short-term instruments.
So one of the biggest themes this year is the rise of active ETFs. And some even call 2023 the year of active ETFs because almost 22% of inflows this year have gone into fixed income ETFs, despite them accounting for just about 6% of the ETF market. And BlackRock recently launched a new fixed income ETF. It is called the BlackRock Flexible Income ETF, BINC is the ticker symbol. And this is managed by Rick Reeder, the well-known fixed income expert at BlackRock. So could you give us an overview of this ETF and how and where it fits into investors' portfolio?
Yeah, so we just launched the BlackRock Flexible Income ETF, ticker BINC. And we've worked with a lot of investors who are looking for ways to add income to portfolios. And they wanted to be able to have the expertise of BlackRock to help them pick between different sectors. So this is an ETF that's going to be holding everything from corporate bonds, high yield bonds, some asset-backed securities, emerging market bonds, and try to provide a very diverse income from a diversified amount of sources. And so the duration on it is going to be, right now it tends to be fairly short, between 2 and 3 years, and the income on the fund is just under 7%. So I think where it fits into portfolios, if people have very fixed income heavy portfolios and they're looking to add in a little bit of credit risk and economic risk back into portfolios, or if anybody's seeking higher levels of income. So we kind of think of this as the plus part of your core plus allocation. So you could pair it with a core bond ETF or a core bond position, and it will add some diversification and some income. And so we've actually had active bond ETFs since 2013. So we're hitting some 10-year track records on some of our other active bond ETFs. But we've definitely got more demand for income-seeking products that can navigate today's market, and that's one of the reasons why we launched BINC.
Now, talking a little bit more about income-seeking ETFs, we know that options-based income ETFs have been very popular with investors this year, particularly in the equities space, those ETFs that provide exposure to equities, and then they write call options to generate additional income. BlackRock, in fact, launched the suite of first BuyWrite fixed income ETFs about a year back, and it has already seen over 900 million in inflows year to date. So these ETFs, basically, they sell call options on the underlying ETFs to generate extra income. Is that correct? Could you tell a little bit more about this suite of products and why they are quite popular with investors?
I'd be happy to. So if we just take a step back and think about BuyWrite investing, it really started on the equity side, where people might have held concentrated stock positions. They wanted to either have a strategy to reduce that position and wanted to collect some income along the way. So they would write a call option on that concentrated stock position, and they would get to collect some income. And then if the position went up, it could get called away, and they could basically reduce their exposure and increase their income. Well, over the years, our bond ETFs have also generated an active call option market, or just options markets on many of our ETFs. So we took a look at this and realized that we could go ahead and launch an ETF that is set up as a fund of funds. So it's holding shares of the underlying ETF. And in this case, we've done a suite of 3 bond BuyWrite ETFs. The tickers are TLTW, so it holds shares of TLT. HYGW, it holds shares of HYG, or a high yield bond ETF, and LQDW, which holds shares of our investment grade corporate bond ETF. And each one of those are going to be holding 1 month at the money call options, and we're going to be rolling those each month. And thus we're able to collect both the income on the underlying bond portfolio and the option premium. And we're passing that through to investors in the form of the monthly income distribution. And we just hit the 1-year track record on each one of these funds. And the distribution yields have ranged between 18 and 20% on these, because we're able to monetize some of the volatility that's been going on in the market. So if you think about your Black-Scholes options theory, the more volatility, the more the option is worth, because there's more potential it might expire in the money. And so this is one of the ways that investors have a view. They want to be invested in these asset classes, treasuries, high yield, corporates, and they want to have more current income in portfolios. And if you think the interest rates are basically going to go sideways, maybe could go up a little bit, and you want to hedge some of that through some more current income, this is one of the ways to do it. So I think we've seen investors who have been buying covered call writing strategies or BuyWrite strategies on the equity side. They're now able to do this with fixed income. And we partnered with the Chicago Board of Options Exchange. They're actually the index provider for this series of funds, and they have all the data on the indices. And so we were able to look at work with them on creating a back test and looking at it in different market environments. And so this is just one of the ways that, because fixed income ETFs have now grown and there's a broader ecosystem around that, we're able to offer a BuyWrite ETF in the fixed income markets for the first time.
Very interesting. I also saw that you recently expanded your iBonds ETF suite, and it now includes TIPS funds, and which makes sense because it seems that inflation is going to remain sticky in the months to come. So could you please provide an overview of these iBonds ETF suite and how investors are using iBonds in their portfolios?
Absolutely. iBonds are our term maturity ETFs. So they're exchange traded funds that hold bonds that mature in each calendar year in the fund's name. And they're designed to mature like a bond. They trade like a stock, and they're diversified like a fund. So we see a lot of investors using these to build bond ladders. You could invest over a specific time horizon. Like, let's say you wanted to just invest through the end of 2024, you could buy one of the 2024 iBonds. Or we even see people using these to manage their required minimum distributions and retirement accounts. And on our iShares.com website, we have a iBonds ladder tool where you can see the current yield. It gets updated every day. You can put in a dollar amount, change the years, and it will show you what the yields, durations, and how diversified that particular bond ladder could be. We just expanded the suite a few weeks ago. So we already had them in municipal bonds, treasuries, investment grade corporates, and high yield. And we launched a fifth suite with TIPS, with Treasury inflation protection securities. And Nina, as you mentioned, we've seen inflation coming back. People are looking for ways to hedge out inflation risks in portfolios. So if you wanted to build a bond ladder and you wanted to make sure that it was going to keep up with inflation, doing it with TIPS is one of the ways you could do that. So we had them in 2024 out to 2033. So each fund is going to hold TIPS that mature in that calendar year, because the US government's last TIP bond each year matures in October. These are going to mature around mid-October of every calendar year. The rest of our iBonds will always mature in December, because we do see munis, treasuries, and corporates do go out to that month. But I think they're a really scalable way for people to put bond ladders within portfolios. We see a lot of financial advisors who are using them in fee-based accounts. They typically buy individual bonds and brokerage accounts. So this is a way for them to offer scalable bond ladders within those fee-based accounts. And we've really seen the iBonds grow this year on the back of higher yields. People just want to buy something and hold it to maturity. So we've seen over $5 billion of inflows into our iBonds this year, and we're managing just under $24 billion in assets across the whole suite.
Very impressive. So it's been a tough year for long-term bond investors and bond investors in general, because bond markets are headed for a consecutive third year of losses, it appears. So as we approach the end of the year, how should investors think about repositioning their portfolios?
I always like to take a step back and say, why should we hold bonds at all? As you highlighted, we've had a tough couple of years in the bond market. We have a framework called the BlackRock bond pyramid, where you can think about the roles of fixed income in your portfolio and help you map to a different purpose and objective. Probably the biggest one is capital preservation. Do you want to preserve the power of your savings? In that situation, if you're looking through the end of the year, you don't know what the Fed's going to do, you don't like the market volatility, that's when I would stick to some of these ultra short or even floating rate funds. We have an ETF that holds floating rate investment grade bonds. The ticker's FLOT. And so that one, if the Fed surprises to the upside and keeps hiking, those bonds are going to reset, and then you'll get more income. So I think if you're most concerned about capital preservation coming into the end of the year, then stick to the ultra short or find things that maybe have floating rates. The second reason to hold bonds is really equity market diversification. We talked a little bit earlier about TLT, but typically whenever the Fed stops hiking, over time, yields will come down, which will add positive price appreciation on bonds over time. So coming into the end of the year, if you want to set up your bond funds allocation for success, I would say add some more intermediate duration. Go out to 5 to 10 years on the curve, because whenever the Fed does stop hiking and those rates normalize and come down, you'll see not only are you collecting more income, but you can also see some positive price appreciation. So that's for people that maybe are more focused on that equity market diversification and want some potential price appreciation in the future. And then the last row of fixed income is really just income. You can really get some high yields now. Yields that were only available in private credit are now accessible using some of our bond ETFs. If I think about emerging market bonds now are paying between 8 and 9%. Some high yield bonds are also paying between 8 and 9%. And then we talked about even more diversified strategies like our BlackRock Flexible Income Fund, BINC, at 7%. So I think if you're somebody who's looking to build and boost income, there's lots of ways you can do it if you're willing to take on a little bit of credit risk. So I think everyone's circumstances are unique and their expectations are time horizons vary. But I think if you just think about this framework and what do you want bonds to do for you, capital preservation, equity market diversification, or income, then maybe you can feel a little bit more comfortable navigating today's bond market.
Great stuff, Karen. We'll have to leave it there. Thank you so much for joining us today and for sharing your insights. That was Karen Vera, head of iShares US Fixed Income Strategy. Let's recap some of the ETF tickers that we discussed, if you want to look at them. We talked about SGOV being very popular. It is 0 to 3 months Treasury bond ETF. We talked about TLT, which remains very popular despite its losses this year. It is the iShares 20-plus year Treasury bond ETF. And if you want to extend your duration a little bit from your cash-like instruments and look at the intermediate part of the yield curve, then the ETF that you could consider is IEI. It is the iShares 3 to 7 year Treasury bond ETF. We also talked about the actively managed income ETF. The ticker symbol there is BINC. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.